British economy ground to a near halt in the last 3 months. That is the consensus estimate of economists that we've surveyed, and there's a great deal of uncertainty about the rest of the year as well. Samuel Hill is fixed income strategist at Royal Bank of Canada, so I think the consensus is 0.2% growth. You've got 0.3% for the second quarter. But what happens the rest of the year? What are you predicting?
Yeah, well, I mean, I think, the risks are for a weak number today. If we do get a weak number, there's a good chance that, that comes either from the extra number of public holidays we had in Q2 or from the disruptions because of the Japanese tsunami. And those are both factors which should rebound in Q3. So I think if we do get a weak number today, it's not necessarily the end of the world.
So what do we expect in Q3, Q4?
Well, we could get a rebound, and we could get as much as 0.7 in Q3, even off the back of, 0.2 or 0.3 today. So I think that is still consistent with the Bank of England believing that it's possible to have this rebalancing of the economy.
They're being optimistic, but not everybody on the MPC is. You have some that would like to leave the door open to more quantitative easing. Do you think if we still see this kind of sluggish growth throughout the rest of the year that that's a possibility? Well,
it is a possibility, but I think, the message from the last set of minutes last week was that at the margin the MPC stepped away from giving a signal about further QE because they took out that direct reference to asset purchases. And I think really that, the message that we would have from our analysis at RBC is that the hurdle for more QE still remains very high.
A certain gentleman's departure from the MPC means that we've heard a lot less about rate hikes, but there are still those voting for hikes. We have inflation above target. They expect it to be above 5%. But the MPC is saying that it's going to peak earlier than they had initially thought. Can they keep going down this road where they don't raise rates?
Well, I mean, we think that that's the risk over the next few months, is that is the problem which has to be addressed. Is if you do get this rebound in Q3, then growth maybe all of a sudden doesn't look quite so bad, and we have got this inflation issue boiling away, and it has been going on for a while, and we think that that's what markets might have to adapt to later on in the year.
And it's this inflation issue that's causing so much weakness in the economy because consumers have seen their incomes eroded.
They have, and I think the thing for markets to focus on, for the gilt market to focus on, is that they will the market, whether these numbers are strong or weak, if their numbers are weak today, the market will focus on the possibility of QE, even though we think the hurdle's high.
Because the gilt market has been doing very well. They've been benefiting from the crisis in Europe. Some people considering the UK a bit of a safe haven, but can they keep doing well if you get more weakness in the economy?
Well, I think gilts will continue to do well if we do have more weakness in the economy, particularly in shorter dated gilts, because of this threat of more QE, even though we think that that's a low probability. But of course the risk on the other side of that is that if you have low growth, then it puts into question the probability of the Chancellor meeting his borrowing targets, in which case maybe the focus comes back to the UK in terms of how good really is our plan to tackle the deficit.
And what do you think?
Well, we think that that there is a risk at this early stage. We're 3 months into the fiscal year. The government's borrowed £39 billion already. That's 32% of its full-year target. That's almost 5 percentage points ahead of the same position last year and the year before that. So the concern for us on the growth figures is not just in terms of monetary policy, it's also in terms of the fiscal policy outlook. And I think at the margin, if you had to pick one or the other, at the moment, you'd say that it's the fiscal policy where there's less sign of any flexibility.
Samuel Hill, thank you very much from RBC Capital Markets.